Okay, sorry for that delay. I had to get things working here. Okay, so we're gonna do the day trading questions first, and then I'll roll right into the swing trading first, and then roll into the day trading. Okay, so the first question was, what kind of postings are appropriate and encouraged for the chat room? We have a little info paper on that to try to describe what we want to do, but basically it's just a community of traders that are professional and respectful of each other and generally have been exposed to my style of trading, and so we have a common frame of reference and a language and an intention to collaborate and learn how to use these systems and learn to adapt them to our own needs. And so you'll see the Euros. I have most of the postings in there right now. It's not a surprise to me that they're trading very well and that they're making tremendous progress in their skills because they're using the chat room for best advantage. It's a place to get accountability with yourself, to share information with your partners, to get feedback from each other, get feedback from me, and you will find that the act of posting trade frames and case studies in there will cause you to do your best work because you'll be receiving peer review, and you don't want to cause harm to others, and you'll feel like you don't want to waste their time, so you'll end up doing your best work and staying focused, and that turns out to have a very positive effect on your trading practice. So I would encourage you to use the chat room exactly for that purpose. Just take a look at some of the archives and you'll see the kinds of things that we talk about. It's trade frames and trading and what are you seeing, and alerts on things that we see developing, clarifications, case studies, flashcards, that kind of stuff. So I encourage you to use the archives. I mean, there's about 8 years of archives in there. Hello, Rick. Howdy, Rick. Yeah, just keep the tone professional and friendly and helpful, and it will be fun. Question number 2, in the 2018 Kansas City weekend trading videos, the question was, notice that I didn't take RLXDs all the time and stayed in trades until I scored a big win. And by doing so, I was able to avoid getting constantly in and out of a trade. Can I talk about the method I use to achieve that? And I'm going to show the example. So I'll say, first of all, if I'm in an owl trade and then I get an RLXD against me, I may use that one as a stop and reverse for a pocket entry. But after the first leg up or so, it's not an automatic exit, and here's why. So in an owl, as an example, we had an unambiguous move down, and then it started to hook back up. And so there was a RLXD, and then there was there was a P1. So you have this unambiguous move, and then you have a P1, the RLs cross outside the river. Then you have the regression line crossing the dragon, and that's number 3. So that's an RLXD right there. And then 4, the dragon rolls up, and then the 30 period regression line also rolls up, and that's what makes this a dragon. An owl entry. So that's an owl entry right there. Well, as this thing continues to go up and up and up and up, let's say we have a successful one. The longer and stronger that is, then you get the dragon and that 10 period line become very, very close to each other. And the river is going to look something like this. And here's the Bollinger Band mean in the river. So you have the river here. Now the river is the trend, right? And in this dragon right here, when these two lines are very close to each other, it's not unusual to see price kind of wobbling like this. And in these little wobbles, you can get an RLXD, and it's just noise. And that's because of mathematics. The the RL10 is a 10 period regression line, and the middle of the dragon is a 10 period simple moving average. So the distance between those two is not very great, and you just get 1 or 2 bars of hesitation, and you're likely to see some crosses like that. So there's 2 reasons why I would get out of this trade with an RLXD. The first one is right after the entry, and so if it crossed the RLXD, and then because the dragon and the 30 rolled up, and then shortly thereafter fell, this is the big trend. Because remember, there was an unambiguous move down, and you had this little period in here where it was the owl, which suggested maybe you could get this kind of a move. But if you get a second RLXD right away, then the owl is a failure. And remember, if this was price, that's what a failed owl looks like. And so now the collapsing dragon is when you draw this line right across from the belly of the dragon or the belly of the RL10. That is our signal for a collapsing dragon, right? And so this is the area where you must, if you're not already short, you must get short here, because the size of this downward trend is, we expect that to be the size of this trend. And this is the signal where you just made a new low, so you have to be short right here. Well, that makes this little bump a pocket. This is like a dead cat. It bounces and then fails to follow through, and there it goes again. Now, in this case, on a failed owl, it's not unusual for this price never to even get to the Bollinger Band mean. That's the Bollinger Band mean right there. And the river is down in here. So on these failed owls, if this thing rolls over and starts failing before it even gets to the Bollinger Band mean, then you have a failed P1, a failed owl, and that makes this a pocket, and that makes an entry, that makes the RLXD here a high priority to cut your losses in the owl and then get short in anticipation of this big move. Then if it does break through this collapsing dragon line, then the first move down is usually a large one, and in that move, you can get your stop to no lose plus dinner for 2. That's my favorite pattern of all time, forever and ever and ever. If I could only trade one thing, that's the thing that I would trade, and that is a failed owl and a collapsing dragon combination. That's the one I would trade. So that's the first case in which the RLXD, which happens right after the owl entry, I will take that one as an exit every single time. Every time. Always. The second time I'll take an RLXD is up after here, like on a 2R battle drill. Like if I made my 2R and I'm trying to preserve this measured move, and I got the move that I wanted, and I can see it starting to stall out like this, and then you get an RLXD that way, and I want to preserve a clear winner, like it's a better than average winner, or maybe it's all the way up to 2R, then I'll use the RLXD as a sign. But in this intermediate area, if this is just chugging along nicely and it's pulling away from the river, and the river has now turned, then I'm not going to automatically take the RLXD. So it depends what the rest of the market and the sector is doing, the time of day, how much money I have in hand, that, in other words, how much profit I'm trying to take. And then I will also use the 4 seasons of MACD as a guide to stay longer in that trend. Now, what do I mean by that? So remember now, on the MACD histogram has a 0 line, and the signal line, will do this. When the MACD line is above the 0 line and the slope is positive, that's the summer. When it's above the 0 line but falling, that's the fall. When it crosses the 0 line, I have a negative bias, a short bias. Above the zero line, I have a positive bias. So once that signal line crosses here, we're in the winter until the slope starts to improve, and then we're in the spring. But I will tell you that if I should be short right here. I will not take the adverse RLXDs as long as we have a negative bias. And as long as we have a positive bias, I won't take the RLXDs on the upside. So use that 4 seasons of MACD histogram as the guide on when to stay longer. What that will let you do is on these kinds of grinding moves that look like this, and the river is still cruising up like this, all of these little pullbacks could very well be an RLXD, but you got to realize that's the noise of the move. And you don't want to keep getting in and out while it's generally trending up. It's generally trending up, as you can see by the rising river, the slope of the river, and you can also see that in the slope of the MACD histogram when it's above the zero line. So use those two things as a guide to keep you from getting out and getting chopped up if you feel like you're getting chopped up. And on the other side, if you see this and that gets you out, and then you see it start to hook up again, as long as you're still above the zero line, you can re-enter right there. As soon as that thing starts to hook back up, you can re-enter right there. You don't have to wait for the emerging dragon to make a new high. You could sell here and then buy it back here as long as the river is up and the MACD histogram is positive. So use the 4 seasons of MACD as a guide, and that should help you. Question 3. Do I always use position sizing R to compute the number of shares to buy and sell for each trade, and use the execution stop only as the initial stop, but never for computing shares? Yes, that's absolutely correct. That's the exact definition of both of those things, and I never vary from that. Never. It's the most important psychological insight that I've discovered in the last 25 years. That's the single most important psychological element to my trading. So I always do it that way. So on the example you have right here, if your risk per trade is 300 and the position sizing R is $1, then the number of shares would be 300. It will always be 300, no matter what the execution R turns out to be. Even if it was 15 cents or 10 cents, I would still only trade 300 shares. Here's why. Let's say I have this little owl move. There's the unambiguous move. Somewhere down in here there was a P1. It crossed the dragon, and now everything rolled up. And so this is like a morning hook, and I'm supposed to buy here. And let's say that my frog box is $1. So the frog box intraday, let's say, is $1. The frog box is the definition between signal and noise. It takes a move, if that was the low, it takes a move greater than a frog box before we can even consider that to be a signal. But if, because of the magic properties of the owl here, we're able to get an entry that's only 20 cents off the bottom, we don't even have an official signal until it's moved $1. So if this little entry right here at only 20 cents instead of a full dollar really is being taken inside the noise. We're still inside the noise level of the turnaround. We're only betting that those 5 signals, those 5 little pieces of evidence, suggest that this is actually a bottom and that we're going to try to get in after only a 20-cent move. Well, if this thing actually moved a full dollar and it became an official signal instead of noise, then our confidence that this was the low of the day is much higher than if it only moved 20 cents off the bottom. And what that means is that after a move only 20 cents off the bottom, the probability that this thing fails from here is going to be greater than the probability if it failed from up here. So this is this, in terms of probability of reversal and taking a full R loss, this is a much less risky trade. And so if I use this one and I'm buying 300 shares, if I'm willing to risk 300 shares on the least risky trade, I don't want to use 20 cents and then have a potential position size of 1,500 shares, because now if this thing collapses, remember the next move is massive. And now I'm holding a 1,500 share position only because I was able to front run that position. So that doesn't increase my confidence. It just means that if this does go on to make an ordinary frog move, by the time it makes a frog move, when I can begin to feel confident about the size of that move and off it goes, I've already got 80 cents a share in hand. I've got 0.8 R in hand, which is already bigger than my average win. And so if it does make a frog box move, I can add a second position right here using some of the money that I made in this area to use markets money. So I've removed my core capital risk by doing so. So I will not vary the size of the position sizing, simply based on the tactics of price and how quickly I can start to increment into the position. I want to use a standard position size, and then I don't have any difference in the stress level that I feel based on the type of pattern. If I had 1,500 shares on this owl, I would be nervous in the service, and my stress level would be high. It would burn up all my emotional resilience. It would make it very much more difficult for me to execute in a calm and routine in almost a disinterested manner, because I'm 5 times as large and I know this thing is much more likely to fail. So by standardizing the position sizing at 300 on the basis of the frog box, I can get incremental improvements based on how soon I can get in prior to the owl entry. Then if I can't find a reason to get in, but it still makes an owl move, I can go ahead and make my entry at the owl with my standard lot of 300 shares. And then I can actually compare the performances of these different entries with with R still meaning the same in terms of dollar figures and all that. So a 1R gain is always a gain of a frog box or of a position sizing risk. So that's the most important psychological idea I've discovered in the last 25 years. Question 4. I said last week that there is a positive relationship between ADX and expectancy on the champions, with ADX greater than 25 is a warning of exceptional performance ahead and that stronger is better. And so the question was, do I use ADX the last 30? No, I use ADX 14 because that's the default position. So I just want to use that. Now I just started adding a page on the ADX statistic to the daily report. So if you will bear with me, let me call one of those up and show you how to interpret that. If you just this is something I've been using in my personal trading, but I haven't. I only recently started adding it back in. So. Sorry. All right, let's see here. Okay, so this is the new page. It's out there. It's going to be around page 10 in the daily. So I'm just showing the Dow for right now. Um, so the strength of trend gives potential alerts for swing and intraday. So I have this sorted now based on the z-score of the ADX. So Merck is the strongest trend based on ADX. So the 500-day average ADX reading for Merck is 23.1, and the standard deviation is 8.3. So if we took the range of normal as average plus or minus one standard deviation, this is what that means. It means that it takes an ADX reading of 31.4 in Merck for it to be an exceptionally strong ADX. So I mean average plus one standard deviation. A two standard deviation ADX reading would have to be 39. That would be really extraordinary. And then in the last 500 days, the single highest reading of ADX in Merck on any one day was 48.8, and that was a z-score of 3. Okay, and then on the downside, an exceptionally sideways or non-trending ADX reading in Merck would have to be 14.9 or less, and then 2 would be 6.6. The lowest reading it's had in the last 500 days was 10.1, and that was had a z-score or a z-min of minus 1.6. So you'll see the fatter tails out here on the strength of trending, because you can't really get below 0 on the ADX. As you can tell, the lowest ever down out of any of these Dow stocks looks like 7.4 in Johnson & Johnson. Right. So in today's reading, the ADX reading in Merck is 42.3, which gives it a z-score of 2.3, and that's the strongest trending stock in the Dow based on relative to his own ADX scores. So even though Pfizer has a reading of 49.5, that's because it swings a little wider on his ADX reading. It went from a biggest of 61 down to 7, and his average is 25. And so he has to get above 51 to be greater than 2 standard deviations. So Merck has a tighter range of ADX measurements. Well, one of the things that you should then recognize is that makes Pfizer a much more interesting swing trade candidate because his ADX reading gets to higher extremes, and so his swings tend to be greater. And that makes a very interesting distinction between those two. Now, the other thing to notice is that Pfizer and Merck are both in that healthcare pharmaceutical sector, and they both have exceptional strength of trend. Well, what does that look like? Let's see if we can see. So what I would tell you is that all other things being equal, Merck and Pfizer, and even Walmart to a certain extent here. Look, there's Johnson & Johnson, and there's United Health. That should tell you something about the strength of the healthcare sector, by the way. This is actually a thing that we can use to look for that kind of sector performance as well. You get the same kind of insights from the pinch and stretch, but because this one uses a standard indicator found in every charting package, this creates a very interesting edge for swing trading, as well as finding good candidates for one-day frog trading. So all of those right there are all better than 25, and they all have, at least the top 3 have a z-score stronger than 1. So Merck, Pfizer, and Walmart should be on our short list for possible frog trades. Let's take a look at the chart if we can on that row. If you have a little bit of time here. On the extremes at the other end, while we're waiting for that chart to load, the least trending symbols, in other words, the most sideways guys of all, are down here with single-digit ADXs and below 15, and they have z-scores of less than -1. So anything really -1.1 or below, I would even go with McDonald's. All these on the bottom here are ones that are probably like a sideways quiet channel or just a sideways non-trending at all, and therefore the next breakout should be very, very interesting. So you can use this chart to help you find additional targets among your population of things that are absolutely untrending, and then the ones that are super trending. All right, let's see if we get. Let's see. Let's take a look at some of these guys here. Let's look at Merck. Should be a super trend here. Yeah, no kidding. Yeah, so this is Merck. Tremendous strength of trend. Pfizer. Tremendous strength. For this breakout from the sideways quiet channel. Very strong ADX. See how wide the river has been. So those low ADXs that then become strong ADXs is when the trend has been sideways for so long that there's now room for it to go. It gives a kind of a reinforcement of the insight that we get from the pinch and stretch, right? So if we looked at the pinch and stretch statistic, let me find where that is. Yeah. There's a Walmart for us. There's Merck on the most positive Z stretch. There's Pfizer. And Johnson and Johnson. So there is a similarity or a resonance between those two reports. So anyway, that's what that ADX score would be with respect to the frog. So anything that has a really strong Z score, anything better than 1, tells me that those have been trending so well as a swing pattern that if you see the intraday starting to get directional in the same direction as the primary trend, that's maybe one where you can use a hybrid frog or make that a priority to get a frog entry on. So Merck, Pfizer, and Walmart. I'd even add Johnson and Johnson in there as a way to get better. Okay, so that's that. Okay, so let me shift now to, let's see, where was that? So this was Peter's question on the, well, it's not letting me, I was trying to make it look bigger. So anyway, you see a generally downward sloping move all day. Now, I want you to notice that when the MACD line is below the 0 line, you want to have a short bias. Now, here's the best short opportunity of all, and you got it with this one, that when you've had an unambiguous move down, and it went through the winter, and now it becomes spring, and then comes up to the 0 line, and then it gets rejected, this is a continuation of the downward trend, so you can be short. It comes up in here, it never crosses the 0 line, stay short, stay short, stay short. Comes up to the 0 line, stay short, stay short, stay short. This is the first time it even crosses the 0 line. So from here all the way down to here, you can ignore those little RLXDs that are happening because they're in line with the primary trend. Remember, the primary trend is down, and that MACD histogram will keep you in that trade. Now, it crosses above the zero line, so you have an upward bias here, but then when it crosses back below the zero line, you pick up the short side trend once more, and now for this entire move from here downward, you stay in the whole time. And these little RLXDs here don't bump you out at all. So use the MACD histogram zero line as a directional filter for the primary trend. Okay, let's shift now to, there were a couple questions on the swing trading, so let me quickly shift over there and put this all in one podcast. Oh, I'm uploading about 200 gigs to Dropbox for all of the workshop files from the live trading and the research weekend. So my internet connection is not that good out here, so I'm uploading them from the office. So hopefully they'll be, first batch will be in overnight. So we're close to being final on that project. Okay. Okay, so new questions for the swing trading course. When trading a continuation pattern, such as a 5DD or a washout, which of the different resistance levels is the best one to use? 10-day high, the last swing high, the hump of the dragon. So here's some thoughts. If you use the indicator called volume at price, which is also known as the market profile, you'll get a sense of how much volume has been transacted at each of those different price levels. And so the price level with the most volume should be the strongest resistance according to that theory, and I would agree with that. So you can add that in stock charts pretty easily, stock charts and then free stock charts and TC2000. So it's called volume at price, and the way that would look is you would see as prices moving up and down over in here, if a lot of volume was transacted here, you would see the volume bars being added from the side. And if there was a lot of volume at this price level, or even more so, you would see this. And then if you saw, it almost looks like a histogram of volume. And so you find where the peak volume is, that turns out to be like the daily pivot point. And this is the strongest resistance because that's where the most volume was transacted. So instead of showing volume by time, this one simply aggregates volume at price. So now if this price came back down to here and then a whole bunch of volume got transacted in here, it would still be adding to this volume bar from the side. And usually you will see this as a combination of red and green. So you'll have some red that shows when they were hitting the asking price, or I mean the lower price in the spread, and then the higher price would show as a green. But the total aggregate is the amount of volume. So that will give you a picture. So if you saw price had moved way up here, but the histogram of volume was very low, you know that this is moving up on very low volume. And when this starts to roll over, you would then not be surprised to see it come back all the way to this price level, and you'll see it start to fill in this volume. It will try to go back to the strongest. It's like the VWAP, the volume weighted average price. So that's a good way to do that. Now, I also think most people look at the last swing high because it easily grabs your attention because it's the thing that stands out the most. So it did that, and then it's coming down here, and everybody can see that as a resistance, the final last gasp of resistance. If you look at the volume weighted average price or the volume at price, you see, hey, there wasn't very much volume transacted here. This was not a significant price for most people, just those few shares that were traded. And when you put the dragon hump on this thing, now what you have is, because you're using a Bollinger Band, this is kind of like the statistically significant price. Everything beyond here is kind of a fat tail. And that's why I like the dragon hump, because that's the statistically significant price level that serves as an alert to potential change in behavior. Where it really rolled over was at the hump of the dragon, and these were just a couple outliers. But that's the real move. So if it can, on the upside, if it recovers and gets through the statistically significant resistance, then it should move here pretty quickly. So I like to act when it breaks the hump and not waiting for the actual the price at the top of the stack. Okay. So if I had to pick, I would use the hump of the dragon for action, and then I would use the actual swing high as a way to predict the way algorithms would probably trade if they were simply saying takes out the previous swing high, then they trigger on the basis that algorithm would trade on the basis of taking out the very highest tick, whereas I'm executing at the hump of the dragon. So I'm already in that position here by the time the algorithms kick in here, and off it goes. So I get a little advantage. The next question is really actually pretty closely related to this. How do I classify resistance levels, which are stronger or more important? Well, it just seems to me that there's so many swing traders that use end-of-day data. The end-of-day high or low seems important. It's important in the market profile as well. And then the pivot points based on market profile and then the way they are computed in the futures pits for the indexes also seem to be important. I would say that the implied resistance level of a range stat from the low or the high of the day. So if intraday it goes like this, and then we say, well, if that's the low of the day, the maximum intraday move is the low of the day plus a range stat or an R stat. So in the past 35 days, only 1/6 of the time did it ever move beyond a range stat. But when it does, this is where you get those enormous fat tails intraday. So the range stat price level, you cannot tell by inspection. You have to do the computations. You have to take the daily report and add a range stat to the low of the day. But that turns out to be a really interesting resistance level intraday. So that's really more of a day trade than a swing trade, but they are related. Next, when choosing my trades, how important is a possible resistance level when selecting the candidates? Well, it's important in the sense that it tells me how much price action from the entry point I can expect for it to be orderly until it hits a resistance level. So in the case of like a, we'll just keep using the owl once more. So if there was an unambiguous move down and we get this, so we end up getting an owl here. If there had been like a strong resistance level right here, I want to say, let's see, it was here and then came down. So this would be a strong resistance level. If I can get this entry, it should be free and clear until it hits that resistance. And then if it starts to fail, I can invoke the 2R battle drill and try to preserve this amount of money, which is relatively easier to gain than the money that's up here inside the resistance. Well, if the resistance channel was very close to my entry, then the probability of failure right away is greater, and I may not want that that move. So if I would actually like to see some distance between my entry and where that first resistance is. Now, the 10-day high might have been here, and I use that for computing reward to risk. But then if I see other resistance levels, and I say, well, if I had 0.6 R in hand, and it got to this resistance level and started to fail, would I be happy and cash it? If it's 0.6, the answer would be yes, because that's my average win. So where the next solid resistance level is compared to my proposed entry actually does have an effect on which trades that I might want to take. Okay. Next, when screening for continuation candidates, how important is a low range, a low yesterday range in comparison to the 14-day? Well, the ATR doesn't really measure range so much as it does strength of trend. I think what you're asking, I think the question, what it really means is, if I'm in a continuation and yesterday was a low range or a small range or a doji, I was using the dragon, so when I said doji, I pronounced it doji. I mean doji. That's funny. Well, I think a doji day on the setup is important because it tells me that we could be in a critical state in which a sharp move out of that congestion area is very possible. So let's say we had a 5-day down, and then we got a nice entry, and it went up, and then we did the 2-hour battle drill, and we got an exit, and now this thing has drifted down, and now it seems to be stabilizing, and now it ends up in a doji. So that, by definition, is a narrow range or a low range. And now I can get long with a pretty tight execution stop. So that's my XR, my execution R. I actually like that because the tighter this range, the less I have to pay to find out that it was wrong. So I'd like a tighter R. Now, a low strength of trend, a low ATR or a low ADX means that the last little bits of the trend were maybe choppy or sideways. That just means that it has failed to fail further, and it may now, as long as if this was a support level and now this is a support level, I see a low and a higher low, then I'm really ready to take this thing long. And so I like to see a doji inside here, all of the things being equal. Okay. All right, so that's everything I wanted to cover. We're about 45 minutes into it. That seems like a good logical place to take a break. So let me just check with you guys one last time. Anything unclear about any of that, or any other questions? And if not, I'll go ahead and get this processed, and I'll hang the replay link in both of the right ports as we go. Okay. So, seeing no other questions, then I'll say thanks a lot, fellas, and take good care. And we will see you in the chat room.